first question is whether you're actually going to save money or owe money. The biggest question is everybody thinks that you're going to save. That is not actually the case. Everybody has to look at their personal fact pattern to see whether they're actually going to see a decrease in their tax or an increase. I think if you live in a state with high income taxes and high real estate taxes, and you are making north of $1 million, you might see your taxes increase. If you're in a state with low state income tax, low real estate taxes, you probably see a decrease. The real area I see is north of 600,000 and below $1 million is where you start to see the crossover from saving money versus maybe actually paying additional taxes.
Yeah, I think the key fact pattern, like Adam said, is really each individual situation is unique to them. So really analyzing that, figuring out what business interests they do or don't have, with some of the other areas where they might save, and kind of focusing in on each individual.
So they've already announced January, February, they're going to come out with amendments or additions or additional interpretations of the rules, which should close some of these loopholes. The biggest question we've seen is if you're a flow-through entity, which is an S-Corp, partnership, or sole proprietor, and this lower tax rate, this 20% deduction, everybody that we're talking to who's in that type of business is rushing and asking the question, should I be switching from an S-Corp to an LLC? Should I switch from an LLC to an S-Corp? As of right now, the answers can be figured out if you run the numbers. That being said, everybody probably needs to wait till end of February, early March, so these additional laws come out and the changes to the rules, then go back and reevaluate your personal fact pattern and then start making changes to restructuring. The worst thing you can do is work with a corporate restructuring attorney, change your entity structure to find out in 6 weeks from now that it actually doesn't work what you did.
Yeah, you want to be very careful in terms of essentially trying to create a permanent solution to maybe a temporary change in the tax laws. Despite it might be several years in play, the truth is it is still a temporary tax change, and you don't necessarily want to make your bed in a way that you can't undo it if whatever it is happening now unwinds. So again, everybody's situation is unique. This will be the area where some of the biggest planning opportunities will happen. But I think until they get some of the fine print ironed out, you don't necessarily want to create permanent planning solutions that either don't work once they make their adjustments, or B, you can't get yourself out of once a Democrat gets in office or something changes, who ultimately then unwinds what was just put in play.
So the two big pieces was a corporate tax law change, which is permanent, and most, if not all, the individual tax law changes are temporary. They're all set to expire at the end of 2025. So We have roughly 6 years for different sections of the laws to be in place. So a lot of things when you look at, you can switch one way, no tax costs, completely free. But what happens is if the law switch back and you want to switch back in, say, 6 years, there could be a cost to that. So some of what clients have to evaluate is what is the savings now for the next few years, or what it might actually cost me when I want to reverse back. The first thing is reach out to your accountant. Let's run the numbers. What we're doing in our office is we're actually taking your 2017 taxes and projecting out what they would be for 18 and running that same scenario, what you had last year versus under the 2018 laws, and then can show you the difference under the exact same fact patterns. The other things you can do is possibly meet with your estate planning attorney. There's a lot of additional estate planning opportunities out there with the increase in the lifetime giving. That was doubled. There should be real planning opportunities that clients can jump on now that I'm not expecting to be changed in the next 2 months with tax law changes.
Yeah, you're finding a lot of clients with a knee-jerk reaction of, especially if they're living in New York or California, is, okay, I need to now sell my house and move, or just sell my house and rent because now I'm not getting a deduction for property taxes. I think, like Adam said, the biggest part is quantifying what these changes might mean for you prior to you making any adjustments to your tax situation, your lifestyle situation. And what we're finding is those clients who might have initially had that knee-jerk reaction. I'm a New York resident, I'm selling my house and I'm moving to Florida. Once you now quantify what the cost of this new tax law is, okay, it's a little bit more reasonable once I factor in the loss of certain deductions on the negative side and then the more preferential rate structure on the positive side. Once you kind of compare both those things together and get to the real cost things, most of the reactions have been, oh, okay, got it. It's not just the con part of it. Let me factor in both the pro and the cons of this decision. And then it becomes a more realistic, okay, this is what the real cost is. Okay, I'm not going to now go to this extreme of doing this, but I would do this, this, or this. So I think you have to really see where you stand before you make those knee-jerk reactions.